Thank you very much. Very kind introduction. I'm very much honored and pleased to be invited here and talk to you on a rather big title, that is World Economy After Lehman's Collapse. In my talk today, I divided my talk into three parts. One of them is the crisis and crash of major currencies. This is the first part. And the second part is capital flow and its sudden stop. And the third, part 3 is government debt problem in Japan. So let me start with the first part of my talk. This is the current crisis. And now looking at the world economy, everybody knows well after Lehman's collapse, the crisis has deepened. It has been transformed from banking crisis to sovereign debt crisis. Burden of balance sheet adjustment has shifted from financial sector to government sector. All the major economies, including United States, European economies, and Japan, face the common risk of government debt crisis. According to the IMF Stability Survey report published September 2011, provided estimate of government debt in terms of nominal GDP. For instance, US is ratio to nominal GDP is 76%, and total amount of government debt 11.2 trillion. Japanese government debt is much larger than US, 11.6 trillion. Therefore, ratio to nominal GDP, according to IMF, 210. Government figure is somewhat lower than this, but I have taken the same standard and employed the IMF number. And overseas investors and residents hold 32% of U.S. government debt. Japanese case, this is the share of government debt held by overseas investors and residents, much smaller, 7%. Euro area, $8.7 trillion, and ratio to GDP is 72%. And the US and Euro area, similar size of debt in terms of this ratio to nominal GDP. And also the proportion of the government bond held by overseas investors and residents, 29%. This is similar to US case. And the primary budget deficit, US, Japan is very, very sizable. US 9% deficit, Japan is 8.6%, Euro area 1.7%, much smaller compared with the US and Japan. And looking at the private sector debt, that is this in terms of this bank's asset, US 99%, Japan 207%, Euro much larger than 229%. This difference reflects the difference in financial structure between United States and on one hand and Japan and the Euro area on the other hand. Both Japan and a European continent countries, this banking sector dominates the financial activities. Therefore, this bank asset divided by nominal GDP is higher. In the case of the United States, 99%, this is not so low in historical perspective. It sums up together with the government debt. This is larger than, this is plus 99 plus 76%, for instance. That implies 160 or 170%. So accumulation of debt is not only at the government sector, but the private sector, there has been a significant accumulation of debt. And Reinhardt, Rogoff, they wrote recently a book, and also they published various NBR working paper. This time is different, the question mark. they argued crisis have accompanied default. Default can have two forms. One of them is external debt default, and another one is the domestic debt default. And in addition to these forms of default, there is a default through hyperinflation. And the currency, the fourth is the currency crash. And today's talk, I focus on this risk of currency crash. Now, start with the euro, the crisis. I named it existential crisis, whether live or die, this euro. Euro area is in an existential crisis. Sovereign debt crisis spreads from periphery countries, pigs, to the core countries like France and even Germany. Rising long-term interest rate, Italy above 7%, and just several days ago above 8% with respect to 3 years government bond. And the CDS spread. CDS is the market for trading of credit worthiness of a companies or a government. And the spread, according to economist Hajime Takada classification, above 1,600, this is a restructuring line. Greece is above this line. And above 600, this is a bailout line. Portugal and Iceland included in this line. Above 200 basis points, this is a pigs line. Now recently Italy, Spain, and France, and Austria also they now above 200. And also there is a risk of downgrading. Some slight downgrading occurred with respect to Belgium, AA to plus to negative WA, something like that. And France case, there is always market rumor. There may be the possibility from AAA to lower grade. So nearly euro is facing the risk whether euro can survive or not. And in addition, capital shortage of financial institutions. According to EU regulatory authority, shortage of capital of the financial institution is 106 billion euro. But the market estimate or the IMF estimate 200 from 200, 300 billion euro. And in addition, recently EU finance minister decided they are going to implement another round of stress test. And according to the stress test, they require the 9% core tier 1 and the sizable haircut on debt of periphery countries. And already it was decided with respect to Greek bond, 50% haircut. Some argues even the 60% haircut. In addition, due to this problem, financial market turmoil, a real economy adversely affected by this financial market problem. Now I find the euro area entered the recession in the fourth quarter of this year, and it's likely, according to my estimate, negative growth rate in 2012. So, what is the needed solution? I was invited 2 years ago, that was at the end of 2009, a Brussels forum. At the Brussels forum, exactly the day before the forum, there had been a crisis in Greece, and there had been emergent a finance ministers meeting, and this forum initially organized to assess the progress of euro to what extent the euro developed well and so on. But exactly what happened is the opposite, and the crisis of euro. And at this session, I was asked by the coordinator, what is the best way to restore the credibility of euro? And my answer was very simple: just go ahead toward the establishing the fiscal union. Otherwise, euro will break up. So that was my answer, and still I think this is the only way. If the euro wants to survive, then only sensible way is move ahead toward the fiscal union. And because there is experience, EMS, before the introduction of euro, European area had the European monetary system. At that time, there had been a speculative attack, 92 and 93, and Mr. Soros played a significant role there. And the solution against this EMS crisis was to introduce the euro, that is, strengthen the movement toward the monetary union. And this time, monetary union is challenged. So I find the only feasible way is to move ahead, otherwise break up. So, but in the short run, but it takes a long time to have a fiscal union. And several steps now are taken, and some more strengthened monitoring of the budgetary process in member countries. And recently, just I had the information that the euro area finance ministers or the prime ministers and the president talked about the more, strengthening the fiscal union. But I find in the short run, anyway, several measures must be taken. I would like to recommend, first thing is the role of ECB, which is very important to stop the sharp rise of government bond, not only Italy, but also possibilities spread to France or Germany. And so it's now absolutely necessary for the ECB to engage in a massive purchase of government bonds. Otherwise, the market reacts more sharply. But I think in order to make this, massive purchase possible, I find it there is one necessary condition. This is the likely loss incurred in this massive purchase of government bond, indemnification, indemnified by the EC Council. So apparently, if the ECB embarked on the massive purchase of government bond, they should be prepared the huge amount of loss that would erode the capital base of ECB. But ECB General Council cannot decide the size of capital base of ECB. It is the European Council that decides the size of capital base of ECB. Then I find it natural that the Economic Council, indemnify the loss arising from this massive purchase of government bond. This is already done with respect to United States and United Kingdom, TARP or QE1 and QE2, and the Bank of England asset purchase facility. This is notably in the case of Bank of England asset purchase security facility. There had been agreement between finance ministers.